So first thing we're going to cover today is going to be my schedule. So the first thing is going to be my schedule. By my schedule, pretty much you guys are going to copy, or you can copy exactly my type of schedule when I wake up, when I go to sleep type stuff. The second thing we're going to cover over is going to be how to predict your income. The third thing, we're going to go over risk management. Fourth thing, we're going to cover over the quarters theory. And then final thing for today that we're going to cover is going to be the RSI. So I'm gonna make sure with the quarters theory and RSI, you guys fully get that down, because it's adding more of the strategy. These are more of what our game plan, pretty much, of what we're going to be doing. So that being said, let's start off with my schedule. So as far as my schedule, I did mention somewhere on day 1 or day 2 about how I like trading during the New York session and the London session, or London, New York. So for me, those times that I'm trading or that I'm up is going to be around 11:30 p.m. Pacific Standard. I am awake on my charts, actively looking for trades. This is for the London session. Okay, so this is mainly for the London session. Not spelled that wrong. So that's for the London session. And I'm looking for trades actively, probably for about maybe one to 2 hours max. Okay. So it's 1 to 2 hours max. And so that means if I'm up at 11:30, and the reason why I'm up a little bit earlier before the London session, because the London session does open at midnight my time, but I'm up 30 minutes because I'm analyzing my charts. I'm looking for trades. Now, you guys being like beginner traders, or if you're just starting off, I would recommend waking up or being up an hour before the London session, so like 11 o'clock Pacific Standard, and looking for trades for about an hour. So you're analyzing your charts, you're doing your analysis, and then once it's 12 o'clock, that's when you're actively trading. So 1 to 2 hours max is what I'm doing trading. So that means if I'm up at 11:30, the latest that I would be up is like 2 a.m. Pacific Standard. And then after that, I go to sleep. So I'm not constantly looking at my chart. Like I know there's some people that are glued to the chart. I'm gonna show you guys how to like not be able to do that using certain type of trades. So that being said, if I'm trading during the London session, or not the London, the New York session. If I'm trading during the New York session, I am getting up around 4:30 a.m. my time. And if you can see, I'm going to bring up the calendar, the Forex market hours right now. If you can see, New York starts at 5 o'clock a.m. my time, Pacific Standard. So I'm up like around 4:30. If you're like brand new, it could be 4 o'clock. Just analyzing your trades. After I do my analysis, if I'm up for the New York, I'm only trading 1 to 2 hours, and that's it. I'm not looking at my charts consistently throughout the day. Now, sometimes I do have my charts open, like I will have them open like this. While if I'm using my computer throughout the day, I'll have it on one of my screens. Just kind of occasionally, every once in a while, looking through, but that's just it. Because once you place a trade, you should keep inside of your trade until either take profit or stop loss gets hit. So it's pretty much like that window, 1 to 2 hours. That kind of gives you a good window. You'll also see the London session and the New York session. So I'm going to write it here. New York session, when I'm up at 5, or I mentioned I get up like 4 o'clock if I do trade during the New York session. I'm usually up like at 4:30, but if you're just starting off 4 o'clock, and then I'm up from like 4, and pretty much throughout my day I'm up from there. But I would stay up um, like actively looking at my charts for like 1 to 2 hours if I'm trading mainly during the New York session. Now, you don't have to trade both sessions. You could trade one or the other, or you could do both if you want to. But it's really your preference, whatever you can do. Some people, they have to get some rest, but they can only trade the New York session. So it really depends on what works best for you. Now, between the London and New York, there is something that's a gap, or not a gap, overlap. There's an overlap that happens, which is about 2 hours between the London and the New York session. If you go to Forex market hours, you see right here, the London closes at 8 o'clock. So that's like 3 hours. That is 3 hours. So 8 o'clock, and then 5 o'clock New York open. So London is still open until 8, and then 5 o'clock it opens. So that 3 hour window, those are good times to trade as well. But I'm only still doing like 1 to 2 hours. You could stay until 8 o'clock, but that's really up to you. Normally I spot my trades. I've gotten so good at this where I can analyze my charts within like 15 minutes and kind of see which pairs I should be looking at for buys and sells. And that's pretty much what I want you guys to get at too, is perfect the analysis where you could just analyze pretty quick and you just be done with your day. Remember, Forex is like an extra source. It can be your main source. And for me personally, it is my main source where I'm just actively looking, but I don't have to spend a lot of time. I did mention on day one where investing isn't really time for money like employee and self-employed. This is more put in money to make more money. So as you're going on throughout your day, you have your money in the market where it's the whole point is to make more money out of it. Which leads me to my next section, how to predict your income. So predicting your income, there is, let me write this down here. How to predict your income. Now, based off of your account size, this is pretty much what I would recommend. Now I mentioned $50 is pretty much like the very minimum that you can start off with trading on your account. But I would recommend still like 500 plus. But let's just say if your account has, wrong area. If your account has anywhere from like, let's say if your account starts off with 250. I'll put on here, the equity on your account is 250. This is the lot size that I'm going to recommend. So the lot size for a $250 account is going to be 0.25. Now, this lot size would be the max lot size that I would recommend. And using my game plan, which is catching 200 micropips. So let me put on here, target pips, 250, I'll put M pips. And it's kind of like points, 250 points, or 250 of these. So from like, on this right side, it says 110.000. Let's just say placing a buy all the way to 110.250. That's 250 micropips. So, or 25 pips. I did mention 1 pip is equal to 10 micropips. So 250 micropips is, or actually it's not 250, sorry. I'm thinking ahead of what I'm going to be covering today, which is going to be the Cordis theory, but it's actually 200 micropips. That's pretty much the daily pip goal right there. So with catching or with a $250 account, doing 0.25, catching 200 micropips for the day. And let me actually, I'm going to bring my calculator just because I don't want to do the math on all these with head, but 200 times 0.25, you are going to be making $50. And this is like a daily target. If you're catching 200 micropips with the max lot size being 0.25, you're going to be making $50 a day off of that. Now, with the equity plan, if every 250, so once this is at 500, this is when your max lot size increases. So then once your account's at 500, you can then increase the max lot size to 0.75. And that means if you place a 0.75 catching 200 micropips, 200 micropips times 0.75, that's times 0.75, that's 150 that you would be making. That is correct. Okay, so so on this side over here, you're increasing every $250. So you increase a lot size every $250. So that means in order for this to increase, actually this is 0.50. I got this one wrong again. So 0.50, this should actually be $100. So then once your equity on your account is at 750, the max lot size is going to be 0.75. The same thing if your target's 200 micropips per day, then you should be making 150. And then after 750, you have to wait until your account reaches 1,000 in order for you to increase your max lot size. And now the max lot size is going to be 1.0. So then 1.0 times 200 micropips, you're then making $200. Now, if you see this game plan, 200 micropips, catching that per day, that's very possible to do. And it doesn't have to be on like one currency pair. Like let's say USD JPY, you don't have to catch all these pips on one pair. You can do like 100 on USD JPY, 100 on Euro USD. And then as long as your pips add up to 200. Once it adds up to 200, you can stop for the day. But this is a reasonable goal that even if on days where there's bad news that happen, where there's like not much volatility in the market, you can still catch 200 micropips. So then knowing this, the max lot size, pretty much that means you can get 100% return on your money in one day if you think about it. I mean not one day, 1 week. So let's say like the $1,000 account, if it's making $200 a day catching 200 micropips and the market's open 5 days a week. So let me do right here times 5. So 200 times 5, you're then making $1,000 at the end of the week. So now your account's at 2,000. And then this is how you start compounding your account. And as far as like my strategy, I'm focused on just catching like 200. Obviously, I can catch more than that, but 200 is like my very minimum. And then I'm just compounding accounts. I can flip like $100 account to 1,000 pretty quick. There's actually going to be a compound plan. It's $100. It's $100 to like 149,000 in I think it was 90-day compound plan, where if you follow it, as long as you're just catching the pips and placing the right lot sizes and having good risk management, which is what we're going to cover next, you should be able to hit that goal. So once your account reaches 1,000, I'm then looking to increase every 500. So then that means, let me give you guys a test here. If, let's say your account's at 1,200, what lot size should we be using? Okay, someone said 1.2. Okay, so 1.0, 1.0, 2.0. So 1,200. Let's say you had a $1,200 account. If your account's at 1,200, you don't increase just yet, because you do increase every 500. After you reach the 1,000 mark, you're increasing every 500. So that means once this, you have to wait until your account is at 1,500. Has to be at 1,500 in order for you to increase your lot size. So then you can then do 1.5 max on the lot size. And then 1.5 catching 200 micropips, you're then making 300. Okay, so then after that, what you're doing is you're just increasing every 500. So if this is at 1,700, you don't increase lot size. You have to keep it at 1.5 until this gets to 2,000. And then once this reaches 2,000, then you can increase this lot size to 2.0. And you'll see, like, based off of this, like every 1,000 is basically 1.0. Like 2,000, 2.0, 3,000, 3.0. Right? But so then 2,000, then after that, we can only increase once it reaches 2,500. And then at 2,500, it would be 2.5, catching 200 micropips. And then this is pretty much how you start predicting. So you just 2.5 times, if you catch 200 micropips, that's how much you're going to be making. Okay, so then after that, 3,000. After that, 3,500, 4,000, 4,500, all the way to 10,000. 10,000 is a last number. Is the last number, and then you're increasing every 1,000. You're increasing every 1,000. So that means 10,000. If it's at 10,500, you have to wait until it's at 11,000. That means the next account size, it would have to be 11,000, and then at 11,000, this is when your lots would be 11.0. And then this is when you start seeing, bigger amounts. If you see like my trades, like the time that I hit 100K a day, that was doing, I did like about 200,000. 200 lot size. Sorry, 200 lot size. And that's pretty much how I hit it. So if you see 200 lot size, let's just say 200 lot size. Who can guess the minimum that I would have needed for a 200 lot account? 200 lots being placed. Let's see who can guess that. Yeah, so Anthony got that right. Yeah, so I would have needed 200K minimum to have placed a 200 lot size. Now, if you think about it, catching 200 micropips, 200 micropips at 200, that's 40,000. That's 40,000 for the day. But I did catch more pips, and I think my lot size was like around 210, but I caught more micropips. It was somewhere like around 1,000 or like 800 range. So that's pretty much how I was able to reach that. But everyone has their levels. If you're starting off at 500 or 250, or even 100, like you have wherever level you're at, and the main thing is getting you to increase your account, and then getting increasing the lot sizes, increasing the daily profit, and then just continue doing that. Now, this next part. So this is how I use LMFX, and this is kind of newer from my previous training. So LMFX, I did mention, has this thing where it's like 100% bonus match. Now, there's other brokers that do have it. I personally prefer LMFX, but let's say LMFX, a bonus match of 500. So bonus match, what it is it doubles your account. It does like ×2 of whatever funds you put in. So that means if I put in 500 into LMFX, so I fund my account 500, the account size will then do ×2 of that, and it's going to increase that to 1,000. So that means whatever whatever you put in, they give you double that amount, but that means we now have higher equity. So now instead of us being here at 500 doing 0.50, now because they doubled our account, we now have 1,000, which now we can do 1.0 max on the lot size and then be making $200. Instead of making $100, now we doubled the income. So just think of it like, because they're giving you that bonus match, you can then double your income if you stick to this plan. But what I do is, because this is kind of seen as risky, I didn't get my name for nothing. I am risking a good amount for my trades, but what I do is I have 5 different accounts or more. But if you see, like when you open up an account, a brokerage account, they'll allow you to have multiple trading accounts. So you can be trading on one, like for example, I have one that's connected to an auto trader, so it's actively trading automatically, but then I'll have my personal accounts and I'll have multiple personal accounts. So like what I suggest, let's say if you have $1,000 total. So that means it's $1,000 of your own money. And by the way, I would not recommend trading money that you're not willing to lose. That's the whole point of investing. It's money you're willing to lose, especially when you're starting off. Like the whole point is not losing your money, but be ready to prepare like if you were to lose the money. It's pretty much what I'm trying to get at. So let's say this $1,000 you put in. The $1,000, what I would do with that 1,000, if that's all you had to be able to invest, what I would do is split it into 5 different accounts. And this is another way to look at trading, which not many people do, but this has definitely have worked for me. So with that $1,000, what I would do is I would then split it into 5 different accounts. And if you do 1,000 divided by 5, that's $200 per account. So that means at 200, I didn't cover like the lower amounts, but anything less than 250. So like 200, it's going to be um, every like $50 below that. So like 150, 100, $50. If you think about $50, it's 0.05, or $100 is 0.10, 150 point, 150 is 0.15, 200 is 0.20. So at 200, you're then doing 0.20s on here. But now you have multiple accounts. So you have 200 on this one, 200 on this one, not 100, 200 on this one. And you just split your money between 5 accounts. Either you can have the funds inside of your account or have it inside of your wallet. Like LMFX has like a wallet. So it's like you'll have one account active, but you know you have the funds to create 4 other accounts. So you would have 200, 400, 600, 800 on the side in the wallet, ready just in case. But if you think about it, who here has played Pac-Man? Put yes in the chat box if you've played Pac-Man. Okay, we got me. Yes, 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 yes. Cool, cool. Yeah, so when you're playing Pac-Man, I think it's like 3 lives. So this concept is just creating multiple lives. Or if you think about cats, like, you know, that saying cats have 9 lives. And in this case, it's like you have 5 lives. So if you were to accidentally blow an account, what you're doing is you're learning now. You're learning like why you placed a dumb trade. And this kind of helps out the psychology side too, because you might have placed a dumb trade that you were just like, damn, you should have never placed that trade. And then now you're screwed. And if you had all your funds, like let's say you had the 1,000 onto just one account, but then you messed up your trading style, you did a 1.0, you kind of like messed up your entire account, then you're done with your investment money, and then you can't trade anymore until you save up more money to invest. So this is how you split it up. You split it up, and let's just say one of them didn't do so well. Say your first account didn't do so well. Okay, because you know that you have the power to get 100% return in 1 week, and let's actually go through it. So if you're doing 0.20 max on your lot size, catching 200 micro pips, so 200 times 0.20, 200 times 0.20, that's $40 a day. So you would be making $40 a day. And then if you do $40 times 5, because the market's open 5 days a week, if you're catching this consistently, then 40 times 5 is $200. So let's say the first in 1 week you did good, you caught your pips, you did max lot size 0.20. Now with that $200 that you made, you can fund it back over here, and then you're back to 5 lives. So then you're just distributing evenly. But now let's say if this 200 over here, you doubled it, you doubled this 200 to 400, then what I would do is I would split that $200. I would split 50, 50, 50, 50. Now all these accounts have $250. So then now you're compounding these accounts, but then still having this this one main account that you're trading off of. So then as you make more money, then you start putting in more of the profit on the side. But this is the thing. If you put in $1,000 into your trading account, the main thing is flipping that $1,000 into $2,000. Once you flip it to 2,000, you want to withdraw whatever you put in. So now you're trading just off of profit money. Okay, does that make sense? Put a yes if that makes sense. If it doesn't, someone said soon Ricky gonna have a gold PJ. I was actually looking into getting the Tesla X and wrapping it gold. I haven't seen that. Okay, so Brian said I should have done this, started with 1K, now you have 700. So yeah, this is what I definitely suggest. This is what I've been doing for a while now. You're really a master. Love it. So the main thing I mentioned, 1,000 to 2,000, withdraw your $1,000. Now you're trading off of profit money. Now, now you're just doing the same thing again. And then with the profit money, you're just focused on doubling that 1,000 to 2,000. But once you double it from 1,000 to 2,000, you don't have to withdraw right away. You just continue compounding your account. As your account starts getting bigger, then you start realizing how much money you need to make. But what I would suggest, first off, with this whole like predicting your income is how much income do you need? Because then that kind of has to do with how much you're going to be withdrawing. Because if you're withdrawing, like let's say 1,000, but then you need 1,000, like you flip 1,000 to 2,000, but then you want to take out 1,000 for bills. Now you're back at 1,000, and then you do the same thing. Once you flip that again, 1,000 to another 1,000, you take out 1,000 again for bills, and it's just going to be a repeating cycle over and over. Okay, so then you're not really compounding your account. Now you're just using Forex as like an ATM, and then if you fully rely on it for income, then that's not going to be really good. But the main thing is when you have a good amount of money and you compound this, once this is at 10,000, let's say this is at 10,000 now. That means each of these accounts are at 2,000. Oops. That means you're splitting all these different accounts at 2,000. Then you're placing two lot size and then catching 200 micropips. Then you're making $400 a day. And then $400 a day that's how much you can make off of a 10K account. Okay. And then $400 a day, like that's, for some people, that's like pretty good. Like I personally wouldn't mind having an extra 400, right? But then once you start getting to the bigger scales, like 20,000, 50,000, then you're talking bigger lot sizes, and then bigger compounding, bigger amounts of funds. This is how you start getting like 5-figure days, and then you start getting to that level of making some good money. To then you decide what you want to do with the money. So I always suggest compounding your accounts, making it bigger and bigger, and then just withdrawing. Let's say 10,000 turns into 20,000. You can take 5,000 off of it. I would actually recommend taking 20% of your profit and keeping 80% in. So keep 20% of profit, and leave 80% compounding. And this is after you have already like done your initial amount. So let's say you put in 1,000. If you flip 1,000 to 2,000, you withdraw the full 1,000, 100%. So you can keep that 100%. But this 80-20 rule only applies to profit. Well, obviously profit, but like the profit that you made after your initial investment. Trevor said, how much is Forex tax when you withdraw from your account? I would speak to an accountant for that. you would want to seek an accountant that has experience with like investors, and it could be specifically for Forex, but depending on where you're at, what country, what state, it varies based off of how much you would need to pay for that. Um, but there's loops around it. We can cover some more about that, but one of the ways is you can have your Forex trading as a business, set up its own business account, set up everything. Um, some brokers don't allow it; they only allow personal accounts. But you can set up as a business, and then you can have like tax write-offs and stuff for that. Like let's say you're eating while trading, or like internet bill for trading, or those things could be considered like tax write-offs. So you have to speak to an accountant and see what would be like the best way, because everyone has like their own different structure. Brandon said, "Is that what you do?" Yes. I do have some personal accounts and some business accounts with trading. And then as far as like bank accounts that I would recommend, TD Bank. If you see TD, TD has Ameritrade, which is for stocks. So they're like pro having Forex traders in their bank accounts. Some people see Forex or stocks or any type of investments online, like if you do cryptocurrency, it can be seen as like high risk for them. Like I've personally got shut down from Wells Fargo and Bank of America because they don't like Forex traders, or they don't like investors. They don't. Well, they like investors as far as like real estate and stuff, which is kind of weird because banks are supposed to love having money because then they play with our money. But when they see like anything like you're receiving income from Forex, or you're receiving income from crypto or whatever, they don't like it. But TD Bank is a good one. I personally right now also use Chase as well, so those two banks are good. But anyways, let's go on to the next. Brandon said you got Navy Federal. Navy Federal, I don't have them. That's because I wasn't previously in the military. I know if you have like family in the military, or if you serve in the military, you can easily get them, especially with like credit. But on to the next section. So risk management. Now, you guys most likely heard the saying, with great power comes great responsibility. That saying is going to apply to this. So with your max lot sizes, it is, it is a good amount. Let's say your take profit is 1,000 micropips, which I mentioned it's 200, but someone wants to make it further. If you're catching more pips, this plan only applies to the 200 micropip plan. If you're catching more than that, like 1,000 micropips, this does not apply anymore. So then you're decreasing the lot size. Because let's say you have a $250 account. Your game plan's catching 200 micropips. And I'm going to pull out this this tool here. So with risk management, there's different kind of ratios. So this right here, this is a long tool. That means I'm getting in for a buy. If you could see green is up top, that means like take profit would be up at this very top level. So price was here, I placed a buy, I'm trying to hit this target, and then stop loss being right here. So this, when it looks like an even box, that means it's a 1-to-1 ratio pretty much. So 1-to-1 ratio. That means, let's say this is 200 micropips going up, but then 200 micropips going down. If I place a one lot, that means in order to place a one lot, I need $1,000 account. But if I place a one lot, I'm going to be making $200 if it hits my take profit, or I'm going to lose $200 if it goes down. Now, if I flip this plan and I'm only catching, if I'm catching 1,000 micropips, which is, this is not the recommended lot size if you're catching 1,000 micropips. This lot size is max for a 200 micropip a day goal. So if this, let's say this is at 1,000 micropips. This is at 1,000, and then this is at 1,000. So that means if you do place a one lot with $1,000 account, and if this comes up and it hits its take profit, that's perfect. That means you 100%, you did 100% in one single trade or one day. So then this 1,000 would turn into 2,000. That'd be cool if it does happen, but you want to prepare for the worst. So if it does drop down, hit your stop loss, and it's 1,000 micropips at 1.0, you're then blowing your entire account. So that's why this is not recommended. You don't want to blow your account off of one trade. And I have some people inside of my signals, even though if I did have some type of video explanation like this, where they would just not have good risk management. And that's why you guys are here. You guys are going to be practicing that and making sure you don't over risk your account. So this 200 micropips, if you're catching 1,000, if you see 200, what is it? 200 times 5 equals 1,000. So we're going to do some math. If your trade was to catch 1,000 micropips, you can see 200 times 5, that equals 1,000 micropips. So since you're doing times 5 on the micropips, since you're increasing on the micropips, that means you need to decrease on the lot size. So if you have $1,000 account and you're catching 1,000 micropips, you could still catch 1,000 micropips. It's not against the rules. I said 200 micropips is what you're aiming for, but you can catch more than that if you want to. The only thing is now your max lot size has to decrease. So this 1.0 would be, let's see, is there a divided thing? No. So it'd be divided by 5. So 1,000 divided by 5, or not 1,000, 1.0 divided by 5. So now your lot size would not be 1.0 max, it's going to be 0.20 max. So now, if you place a trade right here for a buy or a sell at 1,000 micropips, so let's do 0.20 times, let me add that in front here, times 1,000 micropips. You're going to be making the same amount in profit as you would 200 micropips. So if you do the math, 0.20 times 1,000 micropips, it's $200 if it goes up, hits its take profit, or $200 if it goes down. Does that make sense? Put a 1 in the chat box if that makes sense. And if it doesn't, let me know, because I might be explaining it wrong. Okay, everyone's understanding. Perfect. Cool, bunch of 1s. All right. So I'm going to do another example with the same thing, 1,000 micropips. Actually, I'll make it a little bit complicated. I'll do 800. 800 micropips. So if our main game plan is 200 micropips, now 200 times 4 equals 800 micropips. So let's say this is now 800. Okay, 800 on both sides. So that means whatever the lot size is, we have to divide it by 4. And the lot size, we know based off of what equity we have in the account. So if we have, let's do this one, 2,500. So if we have 2,500, we should be placing a 2.5 only, this is max, if we catch 200 micropips. But since we're catching 800 off of this trade, we now do 2.5 divided by 4. So I'm going to do it on my calculator. 2.5 divided by 4. So our lot size is going to be 0.62. It's like 625, but we can't do the extra 5. So it would be like 62 cents per point. So now if I do 0.62 times 800 micropips, I'll do it right now. 0.62 times 800. Give me 1 sec. 0.62 times. I'm getting 496. Give me 1 second. 0.62. Not sure why. My calculation's not coming out too well. Let's see, 0.62 times. Getting 496. I'm not sure why. I think something about this calculation, I might have done it wrong. Let's see, 2.5 divided by 4, 0.625 times 800. Oh, here we go. So that's 500. That's 500, and that would be the normal amount. I forgot because it's 2.5. So if it was 2.5 catching 200 micropips, 2.5 times 200 micropips. Yeah, there we go. So it was right. 2.5 times 200 micropips, you would be making 500 a day off of this, or 500 off of 800 micropips, but you're doing 0.62. So it's either or, you're making the same kind of profit for the day. The only time that you would extend your take profit is when, let's say we have like a head and shoulder pattern. Okay, so we have left shoulder, head, right shoulder. And then necklines like that, and then head to neckline. Let's say that distance is like 800 micropips. That means when it breaks through, it should be 800 micropips. So your target should be here. And then based off of your target, now it's not 200 micropips. You could get in, so you could get in for the 800, or you can get in for the 200 micropips. It's going to be closer, still the same amount of profit if you're using the same lot size, but then you would be closed out sooner compared to later out here. But the thing with this, and why I would use, like if I do catch 800, sometimes your stop loss would be, let's say, up here. Like I personally would put my stop loss above the previous high. Because if you see, like we have resistance like that, and then we have resistance on this downtrend. And then we have resistance right here on this neckline. So it has to break through the neckline, it has to break through downtrend resistance, and it has to break through this resistance here in order to reach my stop loss. So let me put that tool on for short. So let's say I entered in on the break. I'm gonna zoom in here. So my stop loss would probably be up here. Well, it would be up here. This would be the safer area. Up here above the previous high. And then my take profit would be the distance from the head to the neckline. So usually that distance would either be like a 1-to-1 ratio, where it's about even, or or it would be like more profit because well, it actually should be, because based off the head and shoulder, the head is longer than the distance from the right shoulder to neckline. So head to neckline is longer than right shoulder to neckline. So this would be like a little bit above the right shoulder, and then it would drop down. Someone said, can we use trail stop? Yes, we're going to cover over all that stuff later on. But for now, does that make sense as far as like if your profit is longer and you want to catch the bigger amount, then you could place that and catch that lower amount, compared to if it's just 200 micropips, it's going to be here. It is going to be faster profit. You're more likely going to hit that profit for sure, but your stop loss has to be tighter as well. So if your stop loss is not tight, then I would suggest not really doing that. So for like when it's counter trend trades, I would actually recommend like a farther amount, especially if you get those breakouts and everything happening. But when it's like a closer stop loss, those are mainly for, let's say it's going in an uptrend. Okay, so it's going in an uptrend. I'm going to be connecting. I'm going to be connecting this point, this low to this low, and get that support line like that. Okay. Let me just adjust this a little bit higher just so it kind of aligns together. So this low to this low, and then right here, this area right here, so we can see there's what was once resistance is now support on this side. So in this area right here, we should be getting in for a buy once we see that reversal happen. So we would be getting in for a buy, and stop loss should be pretty tight on this one. We can place a long position right here. Stop loss could be anywhere below here, and then take profit could at least be here, right at this very high. And you could see this right here, this is about like a 1-to-3 ratio. So there's different kinds of ratios. I normally, when I do my trades, it's like a 1-to-2 or 1-to-3 ratio. Those are the ratios that I like seeing. So let me do that in like a box format. So let's say this right here is, I'm just going to do it sideways just so it makes more sense. Think of it like a domino. Dominoes are like, it's cut in half. So it's like a 1-to-1. That was like a 1-to-1. But a 1-to-2 ratio would be if your take profit is, one sec, I need to double this one. Okay, so a 1-to-2 ratio would be this times 2. So this is like the 1 right here. Oops, style. That would be 1-to-2. So that means if this is 200 micropips on this side, let's say long, it's 200 micropips. So this is sideways, but if it's 200 micropips on this side, 1-to-2 would mean this is 200, this side's 100. And then 1-to-3 is going to be if it's like this being 3 on the upside and then 1 on the downside. So kind of like this is like a 1-to-3 coming up. That would mean if it's like 900 micropips up here, it would be 300 micropips down here. Or let's say it's 200 down here, it would be 800 or 600 up here. So pretty much having good risk to reward, you're gonna have to want like a 1-to-2 or higher. That means either a 1-to-2 like this, 1-to-3. Usually 1-to-2, 1-to-3 is like the most that I'll go to, and that's because you want to have some room for the market to what's called breathe. So if it does come down like a wick, it's still, your chances of it coming back up are going to be much higher. So that means, let's say you have, back to that example down here, we're going to bring up, let's say 250. You're doing 0.25. So if you have a $250 account doing 0.25, catching 200 mic pips, let's say we did the 1-to-2 ratio. So let's zoom in here. So if you're doing 0.25, catching 200 mic pips, you're going to be making 0.25 times 200. On this side, you're either going to make $50, or that's catching 200 mic pips, or let's say this side you lose, it's 100 mic pips, but on this side you would lose $25. So that's a way to see it. And what I normally do is I would calculate how much I would make and how much I would lose off of a trade, if it hits take profit or if it loses. So if you're catching 200 mic pips, if you have a $250 account and you're losing $25, that's not too much. That's not too much. That can still have you enter into a trade. But let's say you enter the next trade and you have the same thing, 1-to-2 ratio. Now the next trade you make $50. So if you lose 25, that means your account is now at 225. But then your next trade you make $50. Now your account's at 275. So now you're $25 in profit, and that's placing 2 trades. So even if you're not a 50-50 trader, a 50-50 trader means like you win a trade and you lose a trade. Even being a 50% winning trader, you can still be profitable by having good risk management. Okay, so that's why doing like a 1-to-2, 1-to-3 is where I like sticking at, because even being like a 50% winning trader, you could still be profitable. Now, 50%, that should still show you that you need to switch your strategy. Something about your trades aren't doing so well. I normally am around like 80, 75, like plus. I'm not 100% winning trader. There's no trader I've seen out there that's 100%. Like even auto traders and like automatic based off of market movement is still not 100%. So you would want to you would want to have good risk management, so that even if you're 50%, you're still going to be profitable. And then from there, you're just constantly improving on your trades, improving on your entries. But like this example right here, if I have a 1-to-3, you're more likely going to be winning. And that's the whole point of this, is you want to place trades where you're more likely going to win, compared to randomly entering in. Let's say you already know it's an uptrend, but you don't know how to trade, so you enter in when it's coming down, but it's overall an uptrend, and you enter in like right at the middle, compared to entering it right at support, where it's hard for it to break through. And let's say like this is on the 4-hour, but then on the 1-hour, it's showing like an inverted head and shoulder, like inverted head and shoulder, and then we have neckline right here. Like your chances of winning this trade are going to be much better than you not knowing what the heck you're doing. So that's the whole point. And later on, we'll get into tomorrow, getting like take profit 1s and 2s and all that stuff, because like for this right here, this kind of trade, I would target take profit 1. If that's like an inverted head and shoulder, this would be like take profit 1. The distance from neckline to head is about the distance it should go up. This would be like take profit 1, then like take profit 2, and then take profit 3, which will most likely be right here. And that will be with like we'll be able to know that by Fibonacci levels, which we'll cover later on. So based off of time right now, let's see, it's 7:07. We're gonna take a quick. We'll do about like a 10-minute break. 7:08, so like around 7:20. That's about 12-minute break. 12-minute break. Do what you need to do, and then we'll get back into the next section. We're actually going to skip on the quarters theory. We'll see how we are on the quarters theory for today, but we might go into the RSI. We might go into the RSI based off of time, and then we'll cover over quarters theory tomorrow. But yeah, we'll be back in 12 minutes, right at 7:20. I'll see you guys back here. I'm gonna stop recording, pausing the recording now. Okay, so we are back. Let's review some of the questions that we have here. Let's see. Okay, so question was, so you can use 1:2 or 1:3 ratio when you are cashing 200 micropips. Okay, so with the 1:2, 1:3 ratio, it's a little bit complicated catching 200 micropips that way, because that means it's 100. Like let's say 1:2, that means your stop loss would be 100 micropips away, and then 200 micropips take profit. But being down at the 15-minute time frame, you can do that. You can catch 1:2, and later on tomorrow, I'm going to be covering over like how to have take profit 2, like having take profit 1, take profit 2, kind of like how I was mentioning, where you would have take profit 1 and then 2 over here. So then at first it would be a 1-to-1, but then you would be able to come in and make it a 1-to-2 ratio once it passes through take profit 1. And then how to secure your profits and stuff like that. We're going to cover all that. Let's see, other questions we have. Let's see, is that every trade or all trades added up to 0.25? I'm not sure what that question means. Is that every trade or all trades add up to 0.25? What is the most trades you recommend to be in per day? Per day depends on what you see, but usually I'll get in 3-4 different pairs. Sometimes I'm just on one pair and just fully commit onto one pair because I see like so many confirmations on that one. So sometimes you only just need one, but I wouldn't say going past 3 pairs, especially if you're just starting off. Don't go past 3 pairs, because then it starts getting a little complicated looking at one and managing the other. And then if you have like this thing, which usually beginners do have this, where they're actively looking at the charts, just I don't know why they think looking at the charts is going to make the trade any better. It doesn't really do anything. Just place your take profit, place your stop loss, get away. So if you're having like 4 different pairs, and you're like, then your mind's going to be playing all these tricks on you, and it might actually affect your trading. You might go in there and get out of a trade earlier or whatever. So I would definitely suggest, once you have your take profit stop loss goal, don't do anything with your trading. Let's see. Is the 7-day FX mastery part of the mentorship now? Yeah, so basically the 7-day FX mastery is going to be kind of considered like group mentorship, where I'm going to be more active on there helping you guys out. That's why I created the Telegram group. Literally any questions you guys have randomly, just kind of like how you guys are doing the questions right now. Later on in the future, there might be someone that joins in that that wasn't able to come to this live. So you guys get the whole live answers right now, but someone else in the future can ask inside of the group, and most likely me or one of my team members that knows the answer, or even the people inside of the group, because you guys are trained, you guys can help out other people in there as well. So it's kind of like the whole mentorship thing now, but I'm more active in there. I don't know if you guys seen, like, I pretty much reply the same within the same hour. Sometimes within like a couple minutes, I'll reply on there. Depends if I'm available or not. Um, so let's see. And there's something else that I'm going to be adding as far as like mentorship to be able to see your guys' trades with TradingView. So we're going to cover over that later on. Let's see, 7:20 p.m. Pacific Standard. No, that was me. Okay. Do we stop trading after hitting our daily goal? Yes, you can. Now, it depends. If you see a good setup after you hit your daily goal, then you can get in on that other goal. Because let's say you catch 200 now, but you find another setup that's another 200 that's really good. You have like 3, 4, 5 confirmations on it. Then you place a trade on that one. And let's say for the day you catch 400. That means technically now you don't have to trade tomorrow, but you could still trade tomorrow, and then you would have enough trades, and then you'll just like be ahead of the game. So it's never a bad thing to be ahead. Brandon said, with the master account, can you put in 500 and bonus match it to 1K? Can you split it in 5? Okay, I think I know what you mean. No. Well, you can, like, let's say you have 500 in an account. So I don't know if I have that example here. Yeah, I do. So let's say we'll go to the $1,000 example. This would mean if you have $500 and then doing times 2, let's just say bonus match times 2, so that means your account has 1,000. But it doesn't do it off of like the full amount like that. The bonus match happens per account, so it's like this account would need to have a bonus match this account, and when you set up those live accounts, it would ask you on there. It would ask you on there like what if you want a bonus or not, because some people, they don't like dealing with the bonuses. But I'm like, it's pretty simple. You have an extra amount on your account. I don't know if I covered this part as far as a bonus match, but they don't lose their money no matter what. So if you put in 500, they would match it times 2. But if your account does for some reason reach, like, let's say you have a bunch of trades open, you messed up, and it's negative like half of the account or whatever they let you borrow, it would take it out. It would take it out and you would blow your entire account. So that means you can't be like, if you have 500, you can't be like negative 700 on your trades. If you have the full 1,000, you can't be negative 700 because you only have 500 in. So once it takes your funds out, so they would get their money back no matter what. They just give you that extra leverage to be able to trade. So let's say with this, so I mentioned it's 100% bonus match. So let's say we put in the 500. So then we're splitting $100 on each account, right? 100 here, 2, 3, 4, 5. So each account would have 500, but with 100% bonus match, it would then flip your 100 to 200. So I hope that makes sense. But it'll flip your $100 to 200, and then if this account also has 100% bonus match on this side, it would flip your $100 to 200, and then it's going to be like if it's $1,000 total. So that's kind of how it works based off of each account. Let's say one of them doesn't have it, then it's not going to be 1,000. It's going to be 900. So that's how that works. Let's see, another question. Oh, so okay, so this is a good question. So he said, and keep using 0.25 on a 250 account no matter how many trades until hitting 500. So let's say if you have 3 different trades open, the 0.25 max should be the max of all your trades total. So if you have a $500 account doing 0.50 max, but you place, let's say, 3 trades, now this 0.50 has to be divided by 3. And that's if you're catching 200 micropips. But then if you're catching like 800, then you have to do the math on the 800 divided by however many more that is. So I mentioned, like, for this example, it was like times 4, 800. But then, like, we got 0.62. So if you're placing 3 trades on a 0.62, you have to divide 3 divided by 0.62. So that's where it gets a little bit more complicated if you're catching more pips. But if you're just catching 200, just think of it as, let's say you have a 500 doing 0.50, that 0.50 you divide it by 3. Or it's easier doing 750, 0.75, that 0.75 you divide it by 3, that's 0.25 a trade, catching 200 micropips. So that answered that one. Would you recommend just focusing on 3 USD currencies since they are the most volatile? Yes, 3 USD currencies are good to be focusing on. Now, it doesn't mean you have to trade 3 of them all at the same time. You could do 1 at a time, or like sometimes there will be one that shows a good setup, and the other one, it'll take a little bit longer to show that, like for it to, let's say, do a breakout. So you'll enter in on one and you'll get in on the other currency at a different time. Okay, so let's see. So every trade we put in, the lot size should be what recommend us based upon our balance. Yeah, so it's based upon balance and also the micropips that you're catching. This is off of a 200 micropip plan. And increase every 500. So it depends. If if you're between the 250 and 1,000, you're increasing every 250. And anything after that is 500, and then anything past 10,000 is 1,000. Okay. Okay, so what if those 3 trades are losses? Do we keep trading until hitting our goal? So if you lose 3 times in a row, I would suggest there might be something wrong with the way that you're doing your analysis that's making you lose like 3 times in a row. Because usually you'll see like you'll win 2 and you'll lose 1, or even if you lose 2 but win 1, but you have good risk to reward, like that would still be fine. Let's say a 1 to 2, that means you would just end the day off even. But you'll notice if you lose this time, you most likely might lose if you place a trade like right after, because people would like try winning their losses back, and they'll place dumb trades compared to like really thinking about it. Unless you're like in a good state, in a good mental state to be able to place your trade, then you'd be fine. But usually when you've taken a loss, you might feel a little messed up after that, where you're just gonna want to get in and not really think about it too much. So there's going to be some methods I'm going to talk about. This is going to be later on with psychology. Do got that right. So it is called revenge trading. That what I just mentioned right there. But there's different things. By the way, I don't know if you guys see on USD/JPY, very simple analysis. Look, boom, left shoulder, head. Pretty much that right shoulder was right there. Neckline would have been like this. Broke through. Distance from head to neckline is about the distance it should drop once it breaks. So we should be expecting UJ to drop some more. I did like another analysis, I think it was 2 days ago with USD CHF. That one it did like an inverted head and shoulder. I'll actually go through that real quick before I get into the next section. But just to show you guys, like, just with the regular patterns and knowing this stuff, like, stuff works. left shoulder, head, right shoulder, neckline. So pretty much hit like around that take profit level. Did come back. It's looking to do like that kind of retest thing. Actually, it broke through this support. Looks like it's coming back towards like around that neckline area. I'll be pushing up from here. There's going to be some more things that I'm going to show you guys today with the whole RSI thing that helps out with that. But let's see. Okay, so that's it with the questions from what I see. Oh, someone else said EJ now. So you guys are already spotting these patterns. I see inside of the group, like you guys are seeing it. Yeah, Euro JPY. Very easy. Left shoulder, head, right shoulder, neckline. Where that neckline's at is also like resistance on this side. We can see we have support right here, and this is just doing it off the 15. Like I'm not even doing the whole top-down analysis on this, but we have like, it's like support and resistance right here. So we already know like the distance from up here to there is about the distance that it should drop once it breaks. So should be expecting that to drop some more. So then in a situation like this, getting towards like risk to reward, let me do like a short position, and entry would have been like right there. So stop loss, you can see right here, it says 0.226. That means that's the micro pips from the entry. If you were to enter right here, that's how many micro pips of a stop loss. But let's say you take profits over here at 400. So it's basically like around 200. Think of it like 200, 400. So that's about a 1-to-2 ratio. So let's say this is $1,000 account. $1,000 account. Normally catching 200 micropips. This is kind of repeating what I mentioned earlier, but this is good practice. So normally at $1,000 catching 200 micropips, you're doing a 1.0. You're doing a 1.0, but because this is 400 micropips away from the entry, because this is 400 micropips, that's times 2. So 200 times 2 is 400. So now that 2, you divide it by this 1.0. So then you should be placing like a 0.50. If this is the only trade you're doing, it should be a 0.50 that you place here. And let's say you catch that 400 micropips. So then you're still on that game plan. You catch 400 micropips times 0.50. 0.50 times 400 micropips, that's $200 for the day, which is the same amount if you were to catch 200 micropips at 1.0. 1 times 200, you would have been still making 200, but since you're catching more pips, I just want to make sure that that makes sense for you guys. But that's pretty much how you would do it with that is you just doing that. You can see EJ is dropping pretty nice right now. But yeah, there's more confirmations that should have been for this, and you can see stop loss is right above that resistance. So it's above like pretty much this resistance and the resistance on the downtrend. It's also above this neckline. I did this example earlier where it has to break through 3 of these in order for it to hit stop loss. See, Brandon, you said, wow, this is so simple. Yeah, it literally is. People overcomplicate it. The main thing is looking at these patterns, looking at what's happening with the market. Price action is really the main thing. As technical analysis traders, we're just mainly focused on what's happening with the price. After that, fundamentals doesn't really matter too much because fundamental follows with price action. So that's that. Good call on that. Whoever said Simon EJ now. Oh, I know Simon. You did that the mentorship. So that's cool. Okay, so on to the next section. We're gonna skip quarters theory for tomorrow. We're gonna get into RSI, and that's because based off of time that we have right now. So RSI, which is a really good tool, and all the tools are good that I'm showing you guys, but RSI is a pretty good indicator. Now, I did mention as far as indicators should be the secondary focus. The primary focus should be price action. So what you're focused on is mainly the price action first, and then indicators come second. So what RSI stands for is Relative Strength Index, which is going to be part of the homework tonight. Relative Strength Index. Now, if you want to add it onto your charts, you go to indicators. You could search up RSI, or you can type in Relative Strength Index. It should be the first one that pops up. You bring that onto your charts, and it will pop up down here. Okay, so what RSI helps for, RSI helps with identifying the real strength and weakness of the price. And what I mean by the real, I'm actually capitalize this because this is the important part. What I mean by the real strength and weakness of the price is that sometimes you'll be seeing something on the candlesticks that will show you something different on the RSI. So the RSI helps out with identifying the strength and the weakness of the price. So sometimes at the very top, like you'll be seeing it going in an uptrend, but the RSI will be showing signs that it's going in a downtrend, that it's about to go in a downtrend, pretty much. So that's what it's going to help out with. This is an indicator that helps identify the banks. Basically, I can actually write this at the very top. So this indicator is mainly what the banks go off of. So you know how I mentioned earlier how I was taught by institutional traders. Institutional traders will look at bigger time frames, but then they'll also look at things like the RSI. They use other things as well, but these are like some of the main things that are pretty easy to follow, and it's not too complicated. So with my strategy, I try keeping it as simple as possible because I don't know if you guys ever heard of KISS. Keep it simple, stupid is something that I use where I'm not overcomplicating my trades. I try keeping it as clean as possible so I can look at it very clearly and just not overcomplicate with so many crazy indicators. So by saying this, we do have, if you see the way that the RSI is laid out, the RSI goes from 0 to 100. So this very bottom on this side, we could see 0 right here, and then the very top up here, we could see 100. Now I can extend this going down, I can extend this going up, but as far as the settings that I use, so under the inputs, normally when you start this off, it's going to be, I think it's 12 or 14, one of those numbers. You're going to want to change the length to 5. The source, it's going to be close. Make sure it's under close. The style, that's up to you, however you want to customize your chart. Some people like black on here. Me personally, with MMA, I keep it like orange or gold, basically. It's not, yellow doesn't really look like gold. I guess this one kind of looks more gold color. And then with the RSI from 0 to 100, we have these 2 lines in between. We have this line up here, which is right at the 70, if you see on the right-hand side, It's right at the 70 mark. And then we have this line at the very bottom that's at the 30. So these lines are very important, the 70 and the 30. And what they indicate, if you see these, there's this gold lines going up and down. When those gold lines are above the 70, price is overbought. So when price is above 70, price is overbought. I'm gonna actually write that down right here. When price is above 70, price is overbought. And then when price is below 30, price is oversold. So the 30 line is this one at the bottom, the 70 is the one at the top. So let me mark that off right here. So anything below the 30, price is oversold. So normally when the price is below the 30, when it's at the oversold section, it'll go from the oversold, and then the price is gonna push up towards the overbought. And usually it's just going back and forth. It's going from overbought to oversold, overbought, oversold, overbought. It's just going back and forth. So the main thing with this RSI that we're gonna be doing, because I mentioned the real strength and weakness, we're gonna be identifying what's called, we're gonna see fake outs. And the right term for that, which I was writing it out, is called divergence. So with the RSI indicator, we're gonna be seeing the real price compared to what is showing us on the actual chart. So this would help us out identify if it's actually true with what's matching up top. Okay, so let's go into how this actually works. So we're going to be mainly focusing right now on the overbought section. All right. So the way to use overbought is, let me actually draw this out over here. I'm going to move this. So on the RSI, I'm going to write out the lines. Let's say this is 70 right here. And then this is 30. Now it goes from 0 to 100 like it shows down here. But when the price is above the 70, that means it's overbought. But what we're looking for is this slant going like that. So it's basically creating like a lower high. You see this is a high and then it's like a lower high down here. So like if I pull this up, we can see like, let's see, like kind of this section here, it's like a lower high, this section here, lower high, like this section here, lower high. So we're not looking, when it's above the 70, we're not looking for slants going up like that, higher high. So we're looking for the slants coming down. Like even right here, this is not good because it's pretty much sideways. But on this side right here, this is good because it's like a lower high. So we're looking for those like lower high type slants when it's above the 70. And the reason for that is because usually you would see these slants going down like this, but then on the actual chart, let me move this. So on the actual chart up top, we would see this. We would see like a higher high. But then we see on the RSI that it's going down. So this is showing that it's going up. This is showing that it's going down, which means this is called divergence. And we connect this point to this point, and we see up here is showing it's going up, down here is showing it's going down. So then most likely, that means you're spotting that fake out, and then that's when you start seeing it go into the downtrend. And then you would see, like, based off of how we see it. So I'm going to be looking, well, right now I already marked off some areas where it's creating that like lower high above the 70. And then what you can do just so you can match it up is you can get like this line right here, and then you get this vertical line. And then this very peak over here, I'm going to put the vertical line right here. It's basically like this area and then this area here. So I'm going to do it right above. And the crosshairs helps me out. I don't always do this, but if you can see, I'm going to zoom in. All right. Now, we see a slant going down like this. We see it coming down, but right above, we see this going like that. And then right after that, price shoots down. So this was faking us out. This is showing its price is getting stronger, while down here, this was showing price is getting weaker. So this is showing us the real price. Now let's see another area right here. So you can use these vertical lines to help out, like I mentioned, but this point here is this very peak, and then this area here is right there. So we can see right above, we have this going up like that. And right down here, we can see this is getting weaker. Right after that, price drops down. Now, there's no saying how much it would drop down. It's just based off of like the area that you're looking at. So now this example right here. Okay, so I'm gonna do my vertical line on this slant, this point all the way to like this point. So if you see here in this area, it's pretty much kind of confirming. This is showing it's going down. The RSI is showing it's going down. And then right after that, it's still going down. So this is just confirming. That's fine. This is what it should be looking at. Like on these areas over here where it's going up, this should actually be showing on the RSI that it's going up. But if it's showing the opposite, then that means you're actually looking at the real price down here compared to up here. So that's how you spot those fake outs. So let's look at another area. And what I like doing is I like looking at like not looking at the actual charts and just marking off the areas down here. So I'm gonna mark off this area here. You can see the slant coming down. By the way, the second peak, like if you see one peak and then the second peak, it has to be above the 70. So not like this, not like this peak to this peak. It's more like this peak to this peak, or like this peak to this peak, or this one to this one. So I'm gonna do my vertical line going right above on this point. So this point and then this point right here, right above. And then if I come in looking at the actual chart, okay, so this kind of drops down, not so much, but it was showing it was going up, and then right after price dropped down. So it did drop down a little bit. Let's see this area here. So let me do my vertical line here and here. I'm gonna zoom in. I'll look at this closer. And if you can see right here, it's pretty much confirming. This is showing it's going down, this is showing it's going down. So that's fine. But let me do my vertical lines on this side here. So this point here, and then this point here, doing it right above, and coming up to the chart. All right, so this one's a good one. We see this point is doing a higher high, but down here, this is showing price is getting weaker. And then right after that, price drops. Now, the RSI is based off of what time frame you're in. So if you're on like the 15-minute, you can still catch that divergence stuff happening. I mainly look at the RSI on the 1 hour time frame. Okay, so make sure to write that down. We're focused on the 1 hour time frame when doing this. So let me go on to the 1 hour. And what I like looking at is patterns. I like looking for patterns because I know patterns are showing me reversals about to happen. So let's say if we see like head and shoulder at the very top, but on the RSI we see this. So while this is going down like this on the RSI, let's just say this is the RSI, up here it's showing it's going up like that. So this is showing it's getting stronger, and then it starts getting weaker, and then neckline, and then this is just, we have that extra confirmation with the RSI showing that it's getting weaker. So let me show an example of what I mean, and let me lower this and go to like a certain pattern. Okay, so let's look at this area here, which is kind of like a double top pattern happening. Kind of have like 1, 2, kind of takes forever to break through, but it's really that double top happening here, breaks through, comes down. But while this whole thing is happening, let's look at the RSI and see what we actually see. So up here we have 2 tops evenly. So that means on the RSI, we should be seeing 2 tops. But what we do see, let me do my line tool. So this very peak is kind of like around here. And then this second peak up here, if I align it straight down, it's showing it's getting weaker. Actually, it's been showing it's getting weaker ever since over here. So this entire area was showing like it was coming up like that, and then kind of even like that. But over here, we're seeing it's getting weaker. And then after that, what do we see with the price? Price shoots down. So that was good. Another area like right here, we see this is coming down like this. If we align it straight above, and I do it without this vertical line because I have the crosshairs on here where I can look right above. But what I do is I connect the high at this peak, and then I drag this over, and I see it's perfectly aligned to this peak down here. So I put it right here, place it right there. So up here we can see it's doing higher highs. Down here we can see prices getting weaker. And then after that, price shoots down. So you'll see pretty much all the time that it's going to be showing you price getting weaker. Like here, this is showing it's going down. If I align it right above, it's at this point right here. And then right after that, price shoots down. So look for those patterns, use RSI. And yeah, like right here, double top, you can just catch them all over. And I find this kind of fun. Catch that there, price shoots down. So RSI is definitely a really good tool. Using it on the 1 hour time frame. Now, that was just above the 70. Okay, so when it's above the 70, you're looking for those lower highs and looking for that slant coming down like that. Doesn't matter what it's showing up here, you're looking for those slants going down. But when it's below the 30, it's oversold. So now for this side, you're looking for slants coming up. You're looking, think of it as like a higher low. This is a low, this is like a higher low. This is a low, this is a higher low. So you're not looking for slants going the other way like this, not this way. This is a no. You're looking for slants going like this. So then let's say on your on the actual charts, if it's doing like a lower low like this, it's doing a lower low like that, but then you see a higher low down here, then that's showing that price should be going up, and this is showing you the fake out on the very top. So let's go on to the actual charts. I actually already marked off these areas, so let me do the vertical line. So you want to also connect this point and do that line right above. So I've gotten good at it where I don't need this line, but if you're just starting off, I would suggest just using it just so you can mark off which areas. Let me zoom in, and this area here, it's confirming it's going up. We can see now instead of like on these above the 70, you're focused on the top of the market. Below the 30, you're focused on the bottom of the market. Remember that. So you're putting these lines under the price when it's below the 30. But when it's above, like up here, you're moving it. If it's like over here, you're moving this at the very top. So because we're focusing on under 30, we're doing this. So all right, so this part is just confirming and it did go up. That's a good thing. That means the price is showing the truth right here. Now let's see this area. Without looking at the top, it's this point and then this point coming up. It's right there. So let's look at the actual chart, and this is how we spot those. So we can see this. We're getting the lows. So we can see this was creating lower lows, and right here was showing that price is getting stronger. And then right after that, price shot up. So that's good. This area here. So I'm gonna do it without marking up those lines, but I'm gonna do this point to this point. If you can see, it's confirming. It's just showing, this is showing price is getting stronger. This is showing price is getting stronger. When you see higher lows, it's confirming it's getting stronger. So price shot up. All right, this area here, I'm gonna go right above, and this is good. So right here, this is showing it's pretty much going down like that. And then after that, price shoots up. So there's multiple areas where you're going to be seeing that, where right here is going to show the divergence of what's actually being shown at the very top. And then right after that, you're going to see price shooting up. So you can spot that all over. That's going to be part of today's homework. You can see a triple bottom right here. This is another thing I like looking at too. If you see a pattern, like a triple bottom, but this is showing prices getting stronger, that's just confirming that you're good on that buy. Even if this this triple bottom is not really what I like seeing because the neckline's a little bit higher, it's still, you would have hit your profit. So does that make sense, you guys? Put a 1 if that makes sense. Put a 2 if like it doesn't really make too much sense and you want me to cover like some more. I'm getting Spanish here. We got uno. We got 1, 1, 1, 1. Cool. Okay, everyone is getting it. Someone said it, I mean 1, but I would like more. Yeah, so let's go through a different pair. Euro USD. Okay. So okay. If you guys see this point here and this point here, this is going down. But if I see right down here on the RSI, it's this point and this point. So there's a slight slant going up, meaning price is getting a bit stronger. But over here, we're showing prices getting weaker. And then after that, price shoots up. So that's just like a kind of example there. Literally, you can catch these all over. Like right here, what pattern do you guys see right here? This area here, what pattern do you guys see? Someone said triple bottom, not necessarily, a little bit, it's kind of close. Inverted head and shoulder, perfect. You guys are getting it right, okay. So, yeah, we have left shoulder, head, right shoulder there. Okay, we got neckline right there. Neckline to head is about the distance it should be going up. But while that inverted head and shoulder is happening, we see over here, this point right here is right at this left shoulder. This point here is right at the head. And then this point here is like that right shoulder. So on the RSI, we see this is going up like that, meaning price is getting stronger going towards the upside. But over here, we see that lower low, we see that inverted head and shoulder, and then price does shoot up. So the RSI did help us out with this one. Not just that. So this adds like extra confirmation. We have one confirmation, break of neckline, that inverted head and shoulder. That's one confirmation. Second confirmation, RSI. Third confirmation, who knows? Maybe it's hitting off. We have like a major support level right here. Yep. So you can see like there's support in this area right here. So that's a good thing. Another thing that could have been like an extra confirmation for that, we can see that downtrend resistance basically right there. The downtrend resistance was broken. That's like 3+ confirmations that we got off of that. So that would have been good for a trade. You would have entered in, set your proper, let's say take profit is going to be up here, right at that profit, which is exactly 200 micropips. This is good. So 200 micropips, and you can see stop loss would be somewhere below this right shoulder. And you can see that's about like 150 or 130. Doesn't matter, as long as this is less than this, you're fine. Even if it's even, you still should be fine. But we can see it broke out, didn't even come to stop loss. If you would have entered in here, and you would have been good on that trade. So I'm making this very simple, and that's because you want to make trading simple. You want to make trading as simple as possible. So there's so many areas that you can get in on, even areas where it's like chopping of the price, or like, let's say this area here. We're gonna do this right here. So we see this resistance line like that. Okay, now that we have that resistance line, let's actually look in closer. Okay, so we see this point right here, and then this point over here. If we put these points together, it's pretty much this point and this point. So over here, it's showing that it's going sideways, which means down here, we should be seeing the same thing. We should see that peak like that. But we see the peak lower. This is creating like a lower high above the 70. So it should be showing the same thing up here, but it's not. And that's still catching a breakout. Even if it's even, doesn't have to be, it doesn't have to show exactly like, you know, a strong divergence, like going up like that. It could be even like this. We already know it's at a resistance. We already know most likely it's going to hit this area, drop down. And it did. RSI confirmed it, and that would have been good. And you can actually see, if you do like support like that, it broke the support, came up like resistance on that trend line support, double resistance, triple resistance. This actually hit triple resistance right here. That's already 3 confirmations right in this area here. 4th confirmation being, I don't know if you guys see that pattern right here, candlestick pattern. Let's see if you can get that candlestick pattern. What pattern do you guys see there? Bearish engulfing. Perfect. Everyone's getting it right. That's good. So you see a bearish engulfing, that's a 4th confirmation. So 3 confirmations on the RSI or on the support and resistance. So hit 3 resistance right here. 4th confirmation, RSI. 5th confirmation, the candlesticks. 6th confirmation. I mentioned the candlesticks, I like looking at the 15, but you can still see it on the 1 hour. Let's go back to this area. Because sometimes like the engulfing would show like something else that we need to see up here. So this is pretty much like a evening star / shooting star type pattern. This was showing a reversal candlestick all over. So now we have like 5 confirmations there. Let's see, a third, if you were to like chop the price even tighter on the 15-minute time frame, we have like support like that, broke through right here. We're just adding more and more. So as long as you have more than 5 confirmations, you're good. Where is it? Okay, so that being said, for tonight's homework, I'm going to be going over a currency pair right now and just go through it because I know it's getting towards past the time. But someone name out a currency pair, and then we'll do some RSI. The first currency pair that I see on the GU. Okay, GBP USD, and let's do this. So I want you guys for this homework assignment, go on the 1 hour time frame. Go on the 1 hour time frame, get like a good area where there's like a good amount of movement. So we'll say right here. The RSI doesn't have to be this big on the chart. We can kind of lower this down like this so we can see everything nicely, clearly right here. Actually, let me get another area. We'll do right here. Okay, so I have to move this up a little bit. So let's get some areas where we see it. All right, so right here, we have this low. This is going higher right there. We see this point here. If you align it, going down like that. And what I would suggest, because you guys are just starting off, I would suggest putting these lines right at the very areas of those peaks. So you do have to put one up top and one inside of the RSI. And then we can see this is coming down, this shows it's going up. So you guys can put a trend line showing that it's going up like that, or you can use this arrow that you can use. So I'm gonna use it for this one, showing that it's going up. Let's spot another area. So this right here, I'm just gonna write it down, even though if it's not divergence, but I'm just gonna put here that it's confirming. So we see it up here. I mean, we see it on the RSI showing that it's going down, but up here it's confirming. So what I'm gonna do is I'm gonna take a note of it and just put something like confirming with RSI. Okay, let's see another area right here. So here showing it's going up like that, and let me do my vertical line. It's this point to this point, do it down here. So this is showing that it was going down like that. Right after that, price shot up. So let me do with the arrow. Price shot up. Here, price did confirm. Okay, so now you're getting for the bottom side on the RSI, below the 30 and above the 30, above the 70. So you're getting both sides on this. And get like the major areas. You don't have to get like right here. I can see there's some this is going down, but over here is also going down. Like this isn't really a major area compared to like the very peak of this market or like the very low of this market. This was like the low and it's showing it's going up. So let me mark off another area. Okay, we'll do right here. So this showing it's going down. Do my vertical, this point to this point. So at the very top, we see this going up. Down here, we see it going down. Right after that, price shot down. So getting areas like this, marking them off, and once you have them down, you're gonna want to like center it in like a good position because this could be kind of hard showing both areas. Let's see another area. Okay, we'll do this last one here. So this point to here, this showing it's going down. Up here we see it's going like that. I'm gonna do vertical lines. And then showing, indicating that this did drop down right after. Okay, and then once you have a good screenshot area of your homework, you want to center it nicely and take a picture. Okay, so lower this. Oops. All right, so then once you have that screenshot area, you then take the screenshot, and there we go. So that's it for now. Let me know if you guys have any last minute questions. See, do you risk a certain percentage per trade? No, it's not percentage per trade. It's yeah, it's not percentage per trade that I'm trading off of, or that I do my trades off. It's just sticking to like a good risk management plan, max 200. So if you know 1-to-1 ratio is 200-200. So based off of $1,000 account, if you're doing a 1-to-1 ratio with a max like 1.0, you could lose $200. So if you think about it, it's kind of like you can lose 20% of your account. A lot of traders don't do it that way, but because we have multiple accounts, it's kind of like if it's much less than 20% of your account if you think about it. Because if your total amount's 1,000, but you're only doing, but you lose like, well, that's if it's one account. Because if it's you have $1,000 total, then it's $200. Then you're doing 0.20 max. So then the max you can lose if you do a 1-to-1. Let's see, 0.20 times 200. That's like $40. So you lose 20% of a $200 account, but the total amount that you would have of 5 accounts is 1,000. So like $40 out of 1,000 isn't even, it's less than 10%, less than 5% even, like point, it's like 4%. So yeah, going to get a screenshot of this, save it as an image. Okay, so that's it for today. Well, let's see, couple last questions. For some reason, I can't see the 70 and 30 lines in my RSI. If you can't see the 70 and 30 lines, must be something with the settings, maybe even the color. So this has to be checked off. RSI checked off, upper band checked off, lower band checked off. It instantly puts it at 70-30. Make sure these colors are different than your background chart, but they have to be checked off. You recommend 1-to-2, 1-to-3 ratio for us with 3+ confirmations to execute? Yes. It could even be 1-to-1, but you could do 1-to-2. 1-to-2, especially because like you might not start off as like 70% winning trader, so you can't. If you do 1-to-1 and you're 50% winning trader, then you're not going to make any profit, but you're not going to lose any profit if you're 50-50. So 1-to-2 is pretty much what I would recommend, because then you could lose one, you can win the next, and you would still be profitable, being a 50% winning trader. So obviously with time, as you practice these strategies I'm gonna show you, or that I'm showing you, it's gonna get you better and better with your win ratio. But you have to practice, and that's why I want to make sure to do the homework. Okay, so that's it for now, you guys. I'll see you guys for day 5. Actually, there's one more thing. There's one last thing for the homework, because tomorrow we're going to get more into some advanced strategies. It's going to be about Fibonacci. So there's going to be a video that I want you guys to watch. It's going to be listed on the homework section for day 4, but you have to watch it before day 5. And it's not too long of a video. It's going to be some stuff covering over Fibonacci, but tomorrow we'll get into some more advanced strategies. Getting into day 5, kind of day 7 is going to be more of practicing of the strategy and putting everything together, more of that confluence. So make sure, go through those videos, do the homework, and then I'll see you guys tomorrow. Have a good night.